Welcome back to EDS, and in this video I'm going to show you how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing that you want to do is open up any equities underlying. We've got Netflix open at the moment. I thought it'd be good to have Netflix open. Squid Game Season 2 is just being released. Any equities underlying will be fine. All equities have the same expiration dates, and we're just focusing on the expiration dates at the moment. So we want to lock in on an expiration date that we can use to mock up positions moving forwards. Now the one that we want to choose needs to be between 30 and 60 days out in time. It also needs to be a monthly, not a weekly or quarterly expiration date. Now the only expiration date that actually fits that criteria right now is February 21st, which is 53 days out in time. And we're going to take this information and come over to our watch list, and we are simply going to filter out any and all underlyings that have an earnings event over the next 53 days. The reason for this is because we simply don't want earnings to cause a problem with our P&L. Leading up to an earnings announcement, volatility will increase, and as volatility increases, option prices increase, and we are of course selling these contracts, meaning we are short the contracts. We want to sell high, buy low. So we want to sell when volatility is high. We don't want volatility to increase once we're already in the position. We also want to filter out anything with a low liquidity rating level. This is simply because we are only interested in trading liquid markets. The more liquid the market is, the tighter the spread is. The spread is the difference between your bid and ask, and it's what you pay every time you get in and out of a position. So the tighter that is, the less you pay, the more profit you keep. Now, I personally like to order my watch list from high to low IV rank. As we briefly touched on, we want to sell when volatility is high. IV rank and helps us to determine where volatility is in relation to where volatility has been for that specific underlying over the past year. So at this point, we go down the list and we simply see what would fit well inside of our portfolio. Two things to consider. One is what is the underlying, i.e. make sure it complements your portfolio. Keep everything nice and diverse. Don't be too heavy in any one sector or industry. And two, what is the size of your portfolio? If you have a smaller portfolio, you probably want to go with smaller underlyings. If you have a larger portfolio, you probably want to go with larger underlyings. However, that's not to say that if you have a small portfolio, you can't trade larger underlyings. I'm going to show you how you can do that as well. For this example, we are going to focus on XLU. It's trading at just over $75 a share, an IV rank of 58.7, and an absolute IV level of 14%. It is an ETF, it's a utilities ETF, which means that there's no company risk, which means that you will typically have a smoother profit curve or smoother P&L. It does, however, mean that because you're taking on less risk, you will probably most likely collect less premium on entry. Less risk, less reward. However, it's good to have a mix of ETFs and companies in your portfolio as well as some futures. So let's go over to XLU, and we already know we're going to be at 53 days out in time, February 21st. So we can pull up the options chain for February 21st. And now we are presented with the options chain. And as we can see here, the horizontal orange line shows us where the price of XLU is with respect to the strikes, and the vertical orange bar shows us what the expected move is of XLU. So how do we turn this options chain into profit? Well, we're going to be selling contracts, which means that we don't want price to go near our contracts. We don't want price to breach our strikes. We want price to stay away. So we know what the expected move is. So what we're going to do is we're going to sell some contracts outside of the expected move. And that's going to give us a high probability of success. We've also got these dotted blue lines here, which are our standard deviation levels. And we can also use delta as well. So on the left, we've got calls, and on the right, we've got puts. We typically like to be anywhere between 15 and 20 deltas. There is a 19 delta here on the call side at the 80 strike, just outside of the expected move. And on the put side, we have an 18 delta at the 71 strike, again just outside of the expected move. And as you can see here, we have this green bar that's formed, and that's our break-even bar. And as long as price is anywhere within that green bar at expiration, we'll make money, or at the very worst case, break even. And as we can see, the green bar overshadows the orange expected move bar, which is going to lead to a high probability of success for us. If we look in the bottom corner, just above our order, we have a pop of 72%. Pop is probability of profit, which means there is a 72% chance of making at least 1 penny on this position at expiration. So very, very high probability of success. And if we don't want to hold till expiration and we want to get out at, say, 50% of max profit, then we've got a 81% chance of being able to do that at some point over the next 53 days. So we're looking at probabilities of success between 72 and 81. Well, it's just gone up now to 84%. So very, very high probabilities of success here. And as you can see, we would collect 99 cents of premium on entry. Each contract controls 100 shares of the underlying, so you would multiply that out by 100, which gives us a max profit of $99, near enough $100. And our broker would require just under 1.1k in buying power to open this position. So we're looking at slightly under 10% return on capital, which is not bad for an ETF, and with it also being a naked position, which allows us to enjoy the very high probabilities of success. So if this is too much for your portfolio, or you don't want to allocate that much into any single position, or if you have a smaller portfolio, then this is what you can do to reduce your buying power requirement. And this is how you can make XLU is not a larger underlying by any means, but you can extrapolate this same strategy, the same mechanics across much bigger underlyings. I mean, you could do this with Tesla, you could do this with SPX. A lot of people like to do this with SPX for 0-day stuff. But basically all it is so we've sold 2 contracts here. We're just going to buy 2 more contracts. We've sold 2, we're going to buy 2. And the 2 that we buy are going to be outside or further away or further out of the money from the ones that we sold, our short ones. So let's just say we pick $2. So 80, 81, 82, that's $2. We buy the 82 strike, and then we can do the same thing on the put. So $2, so from 71 will be 69, and we buy the 69 strike. And what we've basically done now is we've covered our position. So before it was naked, and now it's covered. Now, if you notice, our buying power requirement has dropped all the way down from just under 1.1k down to $152. Now, how is this possible? Well, the reason why is because we've now got a defined risk. We have a defined max risk, as you can see here. And our risk is defined by whatever the spread is between our short and long contract, which currently is $2, and then you minus the premium that you collect up front, which is now 47 cents. Remember, we're going to have to use some of the premium. It was 99 cents before, but we're going to use some of that premium to pay for these other contracts. So it's $2 minus the premium, which is 47 cents. Multiply that out by 100, and we get a max loss of $153. And our broker knows what our max loss is, so it only needs to hold that much in buying power to cover us in the worst case scenario. Now, what you'll notice is we have a max profit of $48 and a buying power requirement of $152. Now, this is a much, much higher return on capital than what we were looking at before on the naked position. In turn, we now have slightly, only just slightly, lower probabilities of success, as can be seen here. It's 67%. We have a pop-off of 67% and a P50 of 80%, as opposed to the 83-84% that it was before. Now, that is the direct trade-off that comes with having a covered position with having a higher return on capital, your probabilities of success will suffer slightly. And that's the trade-off. Nothing is free in the market, but that is how you can find and manipulate positions to fit inside your portfolio, no matter what size portfolio you have. Now, if you want to know how much buying power you should be allocating to your positions, then click the link in the description. Click on this free position sizing template and it will take you to the spreadsheet. The way it works is you enter in the size of your portfolio at the top. You then enter in what the current VIX level is. Everything below will then be automatically calculated for you. And at this point, you just need to use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to short premium strategies in general. It will tell you the maximum amount of buying power to allocate to undefined risk strategies, defined risk strategies, etc., on a overall portfolio basis and on a position by position basis. There's an explanation giving you all of the information there as well. If you want to learn in more detail about what we do and how we do it, again, link will be in the description. This time, click on EDS Premium. Get yourself signed up. Inside, you will have access to our portfolios that will allow you to see what positions we're placing, how we're managing risk, what adjustments we're making, all in real time. There's a full course as well, so no prior knowledge is required. We will teach you everything that you need to know. If you get stuck, it is a private community, so you can speak with myself directly or with other like-minded individuals. There's a 100% money-back guarantee. So once you have studied our full course and followed our positions for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are. Or you can simply request a full refund. So it's completely risk-free, and it's £1 a month to join right now. The price will be increasing. It's so cheap because we've just launched. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And the aim of EDS Premium is to get you to a point within 6 to 12 months to where you know what to do. You have learned the skill of being able to consistently, profitably write options contracts. And once you've learned that skill, it's something that no one could take away from you for the rest of your life. And we aim to get you to that point within 6 to 12 months to where you don't need any external help or influence. You are always welcome to stay and be part of the community. However, within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.